shipbuilders that are under pressure once again this afternoon. You've got Captain Point Laboratory. It was your top gainer with the gain of 16% yesterday. What's happening today is some sort of profits being taken off the table. The counter is down 4% in trade. First Source is slightly lower. You've got other names such as Sun TV, Godavari, Macrotech, Metropolis, Rail Vikas Nigam that are seeing some cuts in today's trade. But what's catching our attention and has been for the last few days is defense companies. The way some of these counters from the shipbuilding space have been seeing selling is something that's worth getting up and taking notice of. Mazagon Docks is down 9%, Garden Reach is down 7.5%, Cochin Shipyard also sees a gain of 4%. Well, Anushi is standing by with more on what's going on. Anushi, I still remember up until maybe a month ago, we would report every morning on a almost double-digit gain on any of these shipbuilding names. Orders were rolling in, execution was on point. There were no concerns. Of course, arguments were that they looked like expensive stocks, which they still are. But suddenly the tide has turned and the momentum is, getting off some of these counters with the same euphoria that they were gaining. They're now selling off the same gutso. What is going on? Have fundamentals changed?
Absolutely, Samina. As you've mentioned, that just a month ago we were discussing about the good parts of the defense.
And you were finding reasons to justify the rally, right?
Exactly, yeah. But now it does seem that the street has caught on to this, the valuations, which is the main concern that remains on the picture over here. So now if you just look at how the stocks have been doing, it's not just today that the defense stocks have been in focus. In fact, in the last 1 month also, if you have to look at the returns of some of the big counters which have seen such superior gains over the last 1 year, like take a Garden Reach or Mazagon Dock, for example, seen about a 30% or 19% of a downtick in the last 1 month, while Cochin Shipyard again 23% of a downtick over here. Now this is in contrast to their 1-year returns, over which they've gained about 131% to 135% as against Cochin Shipyard, which has almost gone about 5x now. But again, the whole street concerns comes up to the valuations at this point, and this is despite the company's Q1 FY25 results remaining on the stronger side. Now, even Garden Reach, Mazagon reported it's one of its healthiest EBITDA margins in this quarter. But despite that, we are seeing the stock in correction. Now, this is on the back of some of the key brokerage notes coming out with a sell rating on the stock after the kind of run-up that these counters have seen. So just to get a picture on how the valuations are looking at for some of the counters, while Garden Reach current valuations stand at about 57x, Mazagon and Cochin Shipyard following suit at about 45x to 69x. And it is expected in FY25 to 26 that these are going to fall at the levels of 42 to 30x for Garden Reach, while Mazagon also at similar levels at about 23x to 30x. And for Cochin Shipyard, it is going to remain on the higher side of 61x over here. So valuations continues to be a problem over here. That is one reason. Second is also on the fundamental side. So despite the kind of order book that the companies possess, which is on the healthier side, the concern is what is it beyond FY27 that the company can be watching out for after the deliveries are done. What will be the margin picture after that? Let's take Mazagon, for example. Some of the key brokerage notes are expecting the 25 to 26% margins that they currently hold to come down at a level of about 13 to 15%. So that is quite a sharp shift that we are looking at. So again, valuations remain as the key picture. Order backlog growth beyond FY25, and also on the fundamental side, what is the story beyond the current levels that we are looking at? So that's the whole on defense packs, Amina.